Sime Darby expects FY23 to be tough in the face of continuing headwinds from the COVID-19 pandemic, rising inflation and supply chain issues, says Group CEO Datuk Jeffri Salim Davidson. He says that there are more headwinds than the past because inflation is rearing its head, interest rates and borrowing costs are rising, which may end up dampening consumer sentiment. Jeffri adds that supply chain issues have not yet been fully resolved, which could affect the group's future performance, and that the COVID-19 lockdown in China is still impacting its business. On potential mergers and acquisitions, Jeffri says the diversified group is always looking for opportunities to expand its motor division, especially in China and other regions, but didn't elaborate further. Meanwhile, Sime Darby's net profit for the fourth quarter rose 31.8% year-on-year to 278 million on the back of an improved contribution from its industrial division. This was despite revenue for the quarter slipping 4% to 10.85 billion from 11.3 billion previously. Sime Darby declared a second interim dividend of 7.5 cents per share for the quarter, bringing FY22's total payout to 11.5 cents per share. For the full year, Sime Darby's earnings declined 23% to 1.1 billion due to a one-off gain of 272 million in FY21 from the divestment of its stake in Tesco Malaysia. Stripping that out, FY22 net profit was down by 4.3% as a result of lower profit from the industrial and motors business in China. Full-year revenue also came in 4% lower to 42.5 billion from 44.3 billion previously. Jeffri said the group had successfully inked a deal to divest Weifang Port, signifying its exit from the logistics business as it moves towards being a focused entity comprising two strong engines in automotive and heavy equipment. Tenaga Nasional announced that it will invest around 20 billion per year over the next 28 years as capital expenditure for initiatives to fast-track TNB's energy transition plan aimed at reducing its emissions intensity to net zero by 2050. In a statement, President and Chief Executive Officer Datuk Baharin Din said that this will also open opportunities for TNB to more than double its EBIT. Baharin said the company will grow its regulated asset base to 100 billion ringgit by 2050 as TNB continues to invest in the grid of the future. Aside from the national grid, Baharin says TNB is taking 3 other initiatives to fast-track its sustainability agenda. These involve its wholly owned TNB Power Generation, TNB's new energy division, and electric vehicles under its project management office. On TNB Genco, he notes that the acceleration of TNB's decarbonisation plan will increase the enterprise value of TNB Genco for the possibility of an initial public offering. Baharin's remarks come after a Reuters report said that the national power player was planning to start the process next year for a potential $1 billion listing of its power generation business. In what would be the country's largest IPO in a decade, TNB Genco could be valued at about $4 billion according to Reuters sources. TNB Genco aims to capture an estimated 40 billion ringgit in revenue from the domestic generation market by 2050 and is exploring gas and hydropower projects in ASEAN with a target share of approximately 800 megawatt capacity. As for its RE portfolio, NED is targeting 14.3 gigawatt capacity by 2050 with an estimated equity investment of $7 billion. Baharin adds that TNB is also committed to investing 90 million over the next 3 years in order to spur the adoption of EVs, reaching 500,000 cars by 2030 that will contribute 1.25 billion ringgit in annual electricity revenue. AMB Holdings net profit for the first quarter of FY23 rose 8.4% year-on-year to 419.2 million from the 386.6 million it posted last year, due in part to lower impairment charges. However, revenue for the quarter dipped 6.5% to 1.16 billion as a result of lower trading and investment income. No dividend was declared for the quarter. In a statement, Group Chief Executive Officer Datuk Sulaiman Mohamad Tahir said that amid a challenging macro and geopolitical environment, the group commenced a new financial year with a firm PATAMI of 419.2 million while delivering an annualized return on equity of 10%. AMB said net interest income grew by 5.5% year-on-year, while the net interest margin was higher at 2.12% compared with 2.08% in the first quarter of FY22. Sulaiman said there were significant signs of recovery in Malaysia's economic activities across various sectors, supported by firm domestic demand and the recovery chart started in the job market. Ultimately, he says that the banking group is in a strong position to weather these uncertain times and capitalize on the opportunities that lie ahead, particularly given its solid liquidity, credit quality and reserve levels. Kuala Lumpur Kepong's net profit for the third quarter declined 29% year-on-year to 558.3 million due to the absence of a disposal gain from an associate that had been included the year before. KLK clarified that its pre-tax profit would be 20% higher if the fair surplus value of 324.3 million on the disposal of Ora Muhibah was excluded from the third quarter of FY23. Revenue for the quarter rose 35% to 6.96 billion from 5.17 billion as its plantation segment reported a substantial increase in profit driven by higher CPO and palm kernel selling prices. As for its prospects, KLK said although CPO prices have been knocked off from its historical highs, the supply of vegetable oils globally is still tight and prices are expected to be supported at current levels. KLK says apart from softening commodity prices, the operating environment for the plantation sector in the next quarter will be challenging with supply chain disruptions and inflationary pressures on fertilizer, agrochemicals and fuel prices. The planter says it has taken steps to mitigate these risks by continuing its efforts to aggressively boost productivity and enhance its mechanization programs. Overall, KLK expects to deliver a favorable set of results for FY22. AME Real Estate Investment Trust, which is en route to list on the main market on September 20th, plans to acquire industrial properties from third-party vendors in central and northern regions of Peninsular Malaysia. It said the mandate to acquire assets beyond Johor provides AME REIT the flexibility and opportunity to expand the reach of its property trust to generate stable cash flows and potential long-term income and capital growth. The group will also be leveraging the future property development projects of its sponsor, AME Elite Consortium, which has existing projects in Johor, while also seeking to develop industrial parks in central and northern Peninsular Malaysia. Chairman and Executive Director of iREIT Managers, the management company of AME REIT, Simon Lee Saibun says key economic zones such as Selangor, Johor and Penang have attracted substantial local and foreign direct investments on the industrial front. He adds that its sponsor recognizes the vast potential and also intends to replicate their managed industrial parks concept in the same locations. Lee says the AME REIT will have ample debt headroom of up to 240.8 million ringgit to pursue potential acquisitions upon listing based on the prescribed limit of 50% of total REIT asset value.